Good evening and welcome to Capital Markets. I'm Tempula Shaju. It's 1 week since the shift in Nigeria's FX policy from a fixed regime to a market-driven two-way quote interbank system. Coming after this milestone, however, is Fitch Ratings assessment of Nigeria, downgrading the country from BB- to B+, which means highly speculative non-investment grade. On this note, Nigeria's securities markets, as well as sovereign euro bonds, which rallied last week on the FX policy news, retracted in reaction to the rating downgrade, and partly due to the impact of the Brexit referendum result. These combined shocks incited sell pressure on equities, while mixed sentiments trailed the bonds market, just as stocks at the global market plunged and oil prices tanked on Brexit results. The new interbank FX market framework became operational this week. The adoption of a single interbank market saw the end of the official peg of 197 naira to a US dollar on the local unit, which depreciated to 281 naira 50 kobo. Opening bids at the interbank market on Monday ranged largely between 250 naira to the greenback and 266 naira as market participants geared up for the start of trade, while markets tried to determine the new interbank rates. This evening on the program, we'll be joined by an Associate Vice President at the Markets Development and Regulation at the FMDQ OTC. She is Jumoke Olaniyo. She's going to be here to help us review the first week of trading at the FX interbank market, as well as paint us a picture of what the futures market anticipated next week Monday would look like. But before then, let's check in on some market news.
Fitch Ratings has downgraded Nigeria's long-term foreign currency issuer default rating to B+ from BB- and long-term local currency IDR to BB- from BB. According to the agency, the country's fiscal and external vulnerability has worsened due to a sharp fall in oil revenue and slow fiscal and monetary adjustments from the government. The agency says it expects Nigeria's current account deficit to widen to 3.3% of GDP in 2016 from 2.6% in 2015, and inflation to end the year at lower than 12%. Fitch forecasts GDP growth to fall to 1.5% in 2016, down from 2% in the previous year, after contracting by 0.4% year-on-year in the first quarter of 2016, partly due to low forex liquidity. The ratings agency, however, maintained a stable outlook for Africa's biggest economy. It was a sea of red for markets globally on Friday, after Britain surprisingly voted to leave the 28-member state bloc, the European Union. Brexit resonated across currencies, commodities and stock markets around the world. The yen and the euro were all down, while the pound plunged by 8.29% to a 30-year low of 1.36 at 8 p.m. local time. Major European stock markets all slumped, while France's CAC 30 posting the biggest loss of 8.04%. In Asia, Japan's Nikkei 225 index nosedived as much as 8% at one point and posted its worst trading day since March 15, 2011. On Wall Street, the S&P 500 fell by 3.32% at midday, while Morgan Stanley Capital Index for African Frontiers markets was off track 0.5%. The impact on the commodities market saw oil prices slump, while gold rallied to a two-year high. Analysts at EcoBank Research Group released a report that says currency volatility in emerging and frontier markets is likely to rise, and some currencies are likely to weaken as investor risk aversion towards such markets increase as the UK exits the EU. According to the analysts, Middle African currencies linked to the euro will be hit hardest, as well as those with strong trade links such as South Africa and Kenya. The analysts expect Africa's currency in capital markets to remain volatile, but given that Britain's exit strategy from the EU is unlikely to be completed anytime soon, calm is expected to return to the markets and currencies should recover some of their lost ground. As analysts continue to react to Brexit, one of the latest opinions is that the result will create a positive impact on certain sectors of the Nigerian economy. One of such experts is the Managing Director of First City Monument Bank, Mr. Ladi Balogun. Expressing his views on Britain's vote to exit the European Union, Mr. Balogun says the better days lies ahead for the Naira.
I think it's one of those things. It's a lesson for all of us to realize that the voice of the people can be very powerful. The establishment always needs to take into consideration, the voice of the people. I actually think that we're still uncertain just because there's been a no vote. We don't necessarily know what this will mean, whether Britain will fully exit the EU or whether they will have some kind of hybrid form with a very reduced level of influence from Europe, but still being somehow involved. There are implications we know for Scotland and many other implications for other European countries as well that have been considering this. So it's very early to tell. I think it's just a surprise to everybody that this has happened. But at the same time, I think in terms of Nigeria, I don't think we have reason to worry. I believe that should the pound be slightly weaker, it's not a bad thing for Nigeria because I'm sure the UK is one of the main currencies or countries where Nigerians, when they spend offshore, spend. So it will reduce the cost of whatever Nigerians buy in the UK. I also think that it presents an opportunity for us generally because the UK may be also looking wider than Europe for trade relationships and trade agreements, and therefore we may be able to do something more with a key partner like the UK. But ultimately, I think that there's a lot of uncertainty, and that's the thing that worries people. We don't know what the uncertainty will mean, but I think ultimately things will settle down, and everyone will move forward.
The FX interbank markets may be in need of more activities at the sports market in order to thrive. This is coming from the chief executive of financial derivatives company, Mr. Bismarck Rwani. According to Mr. Rwani, the much expected futures markets will be a submission to the spot market's trends.
First of all, it's a process. I think the first day we had a spot market where we did $500 million. Then we did a forward contract of about 3.5. So total dollar commitment on the first day was about $4 billion. Then we saw paucity. That is very limited, thin trading for the next 4 days. What needs to be done is you have to make the spot market lively. We need to do an average of about 20, 30, 40, $50 million a day. So the central bank is buying and selling actively, and so you have an active spot market. The futures market that is going to start on Monday will be a summation to a large extent of what the spot market trends are seeing. But you're not going to have too many people coming to a futures market if the spot market is illiquid. So there has to be active spot trading, two-way quotes, and then we have to be audacious and have to be brave about it. I think that there's too much emphasis being placed on the reserves. reserves may run down, but our trade credit will open up, and that will give us more resources to make sure that our market is 1, liquid, 2, transparent, and 3, perfect.
The Nigerian Stock Exchange has reported an operating surplus of 1.86 billion naira for the 2015 financial year. The growth comes despite the harsh operating environment of the past year. This was disclosed to daily members by the leadership of the Stock Exchange at its 55th annual general meeting held in Lagos.